And it's so easy, particularly with these growth stories, right? Companies that aren't making any money now, but could be, the next Tesla, the next Amazon, to really put the blinders on and see that company through that lens of, yes, this is the next Amazon, right? It's easy to fool ourselves.
Hey everyone, my name is Jack. I'm a 23-year-old real estate investor and soon-to-be attorney, and on this channel I cover a variety of topics as they relate to investing, real estate, the markets, and pretty much everything as it has to do with personal finance. So if you like that sort of content, be sure to have a look around the channel, and if you like what you see, be sure to subscribe. Today I want to talk about value investing and analyzing risks when you're picking stocks, if that's something you're interested in. And to help me with that, I'm joined by Brad Kaellner, the stock compounder. He has his own YouTube channel on stock valuation, risk, looking at what great investors are doing. He has a lot of great content about value investing, so definitely go check it out. But without further ado, let's get into it. All right, Brad, thanks for joining me. What is value investing, first off, for anyone who's unfamiliar?
So to me, value investing is paying less for something than what it's worth, right? And the key there is to come up with what it's worth, because unlike with bonds where you have what they're paying you each year, they have the coupon on them. Warren Buffett likes to say stocks are basically bonds without the coupon printed on them. So it's up to us to kind of project out what the business is going to be generating in terms of cash from now until Judgment Day, and discounting that back at a reasonable discount rate to come up with, well, what is the value today? If you can pay a lot less than you think it's worth, then you have that built-in margin of safety, and you can be wrong about what you think the business is going to do in the future. You can be very wrong and still make money if you're buying with that significant margin of safety.
Could you explain a little bit more about that term, margin of safety? What is that?
Margin of safety. So Buffett talks about how, when you're building a bridge, right? You build the bridge to withstand, say, 30,000 pounds going across it at any given time. But you put on the sign before the bridge, not to exceed 10,000 pounds, right? And that's the margin of safety concept, where what you think something is worth, say you think it's worth $30, to kind of follow this analogy, you're only paying $10 for it. So that gives you kind of a safety net if the future unfolds in a way that's very different from how you think it's going to unfold.
What are some things that could start cutting into that margin of safety? What do you have to worry about when you get a company that you're thinking about investing in? What's the first few things that you might look at?
Right. Well, I saw a tweet. I've been more active on Twitter recently, and I saw a tweet that said, "In business, failure is the norm. Success is the exception." And, I hear Monish Pabrai say all the time, capitalism is brutal, right? There's all these businesses that are coming after your market share, that are trying to destroy you, right? Trying to displace your share of the market. So does this company have a durable competitive advantage? Is it going to be as formidable, as strong as a company 10 years from now as it is today? Hopefully even stronger than it is today. And, some things to look for. Is it the low-cost producer? Does the product that it makes, does it have some advantage in being able to produce that at the lowest cost as compared to the competition? Does it have an incredible brand? Is the management team, very competent in that area? And is management, do they have integrity? Are they going to be making decisions that are aligned with shareholders? So there's many more, but those are a few things that I think about before making an investment.
So that's really a lot of factors just to start with. Since there's a lot of things that go into a business, it's not just a stock chart, as many people might look at it. They might look at the history and think, oh, this seems pretty underpriced compared to where it was a year ago, without actually looking at the fundamentals of the business. So I've heard this term thrown around a lot, value trap, where you might see a company that looks like it's trading underneath what it's actually worth. What is a value trap exactly?
Yeah, so how I understand value trap is you dig into the business, you come up with what the value is, and it appears that the price is significantly below what the business is worth. But you look back through the history and you see, oh, well, this thing has been trading at a discount for years. Maybe there's a reason that investors are looking at this and, each year deciding, okay, this thing is worth significantly less than kind of maybe what the underlying business fundamentals would suggest that it's worth.
Are there any telltale signs that would scream this is a value trap as opposed to some other company that might not be?
Well, one sign I think we mentioned in the last video about Equity Commonwealth is, if you go to Value Investors Club and you're looking at previous write-ups, and there's a write-up every other year on this company. To me, that's a red flag, because it says, all right, yeah, maybe this investor thinks it's trading at a discount to value today, but there are many investors in the past who have seen the same thing. And for whatever reason, there hasn't been a catalyst, or there hasn't been that merging between, what the investors think it's worth and or what the market thinks it's worth and what the balance sheet, what the financial statements say that it's worth.
When it comes to the actual company itself, when you're looking at the balance sheet, what exactly are you looking for there?
Probably the biggest thing I look for in the balance sheet is, what is the debt as compared to the operating income of the business over the last year. Phil Town is big on excluding companies who have debt that's more than 3 times recent operating income. And the big problem with debt is that if you have a management team that aren't aligned with the equity investors, with the stock investors, and it's starting to seem like the debt is running away, it's very easy for them to decide, well, let's just declare bankruptcy. Let's get rid of all these equity investors. Let's kind of start over in a sense. So that's the biggest thing I look for is debt.
So debt is a big risk, and that's really for any business. Of course, there are different types of debt that you might have to worry about. But what about the cash flow position? Because I know there's a lot of companies that have recently IPO'd even that are quite unprofitable. When a company is unprofitable, do you even consider it? Is there sort of a certain threshold of free cash flow or profits that you really want to see before you invest? Or are you willing to take a chance on a company that might be pretty unprofitable?
It really comes down to, all right, how well do you understand the business? Even if it's not profitable today, do you have confidence that you can kind of project what the company is going to be doing, 5, 10, 15 years into the future? And if you have that confidence, and you come up with a value based on that projection, and what the company is trading at today, like I said, is significantly less. You might need an even greater margin of safety in that situation, because it's a lot harder for a company to go from kind of negative cash flow, negative earnings, to becoming this, great company than it is for a well-established company that's churning out cash year after year. And it's so easy, particularly with these growth stories, right? Companies that aren't making any money now, but could be, the next Tesla, the next Amazon, to really put the blinders on and see that company through that lens of, yes, this is the next Amazon, right? It's easy to fool ourselves. So, in those situations especially, it's really important to, as Charlie Munger says, invert the story. One of the things I really appreciate about Jack Dorsey, when he was raising money for Twitter, he came up with like 170 some reasons that Twitter would fail. And that was his pitch to investors. And it's just a testament to his brilliance as a CEO, as an entrepreneur. So important. And that's really what risk is. It's about understanding what could go wrong here. This is my favorite book on risk, The Most Important Thing, illuminated by Howard Marks. And probably the best quote I got from this book is, risk means more things can happen than do happen, right? So investing is all about probabilities. Just because Tesla 10x'd in the last year, does not mean that was the probable outcome for Tesla. So you've got all of these investors who are kicking themselves for not getting into Tesla, because it seems obvious now that it was a sure thing that Tesla was just going to, do what it's done. But it's just not true. That's the one of the hardest things about investing is figuring out what are the probabilities of different outcomes and making investment decisions based on those. Because again, those probabilities, they're not printed anywhere, right? We don't know what they are. All we know is the outcome that happened without any idea of what probability that was.
You kind of mentioned it with Jack Dorsey and great founders. What about a management team are you looking for when it comes to risk?
Well, so a few things I look for with management. The biggest thing is, what is their ownership in the business? Okay. Is it an owner-operator type company? This is something I picked up from Chris Meyer, who wrote 100 Baggers, which is a fantastic book. Are my interests as a stock investor aligned with the interests of management? Another thing I'll mention is, if you go back through, say, the last 5-10 years of annual reports, what did the management team say they were going to do? Okay. Each time you see in an annual report, what was the intention? What was their goal? What did they say they were going to do? And then you read the next annual report. Did they do it? Right. First of all. Second of all, if they didn't do it, do they talk about why it didn't happen or didn't work out? Or do they just kind of sweep it under the rug?
So, Brad, when you're looking at all these factors, it seems like it could be quite a lot to juggle. So how do you actually start researching these companies and finding these opportunities? Are you doing everything from scratch? What's your process?
Right. So I think this is one of the best kept secrets. It's not even a secret, but it's something most value investors don't do. Okay. Monish Pabrai calls it bowling with bumpers. And he says, if you're playing to win, right, and you're offered bowling without bumpers, or you're offered bowling with bumpers, you always take the bowling with bumpers. And the thing I'm referring to here is, as investors, we have this unique characteristic of the game we're playing, that we get to see what the best players in the game are doing. Okay. Every quarter, investors who manage over $100 million have to disclose what they bought, what they sold, what they're holding in the last quarter. That is an enormous advantage. It's incredible, really. And all of the greatest investors that I follow do this. It's not something that just the little guys should be doing. It's everyone. We basically get to see, all right, what are the best in the world putting their money on, right? This is their job. This is their career. This is their livelihood. And we get to see what bets they're making. So the place I start is, what are the investors that I respect the most buying in the last quarter? So that is my starting list of companies to dig through. So, I'll create a list of that. I'll go to Value Investors Club. I'll see which of them have write-ups recently. I'll go to Corner of Berkshire and Fairfax, see what people in there are saying about the company. See if it's a company I think I can understand. Most of them are companies that I won't be able to understand. So those are gone, okay? So maybe there's a handful left each quarter that I'll take a deeper look into. And how this plays into risk, well, it's kind of obvious with the bowling with bumpers analogy. But if you have one of the best investors in the world who's already looked at this company and what the risks are and decided, okay, I'm willing to accept those risks. I think there's, an asymmetric upside to downside here. That's usually why they bet on that. That doesn't mean I don't need to understand the risks myself, but it's going to weed out a lot of the most kind of egregious, risky opportunities, if I use that as a starting list.
Would you say that that's probably a good way for a beginner investor to start learning about what big investors are doing? Just go ahead and start looking at 13Fs and get a feel that way?
If you're someone who's ready to start investing in individual companies, like if you've gotten to that point, absolutely. I think that is the place to start. Look at what the greatest investors have bought recently and try to understand those businesses, try to understand the investment case for those businesses. And like I said, you don't have to start from scratch. You can look at write-ups that other great investors have done. But to me, that's the safest way to start.
So anyways, Brad, that's enough about risk. Tell me a little bit more about you. How'd you get your start in stocks? And tell us a little bit more about your channel as well.
Sure. Well, I'll do kind of the short version. So I studied as a mechanical engineer at UW-Madison, did the engineering thing for a little while. And I realized, for too long that just working a 9-to-5 job for my entire life really wasn't going to get me to financial independence very quickly at all. I needed something more than just collecting a paycheck. And at some point I got, I read Rich Dad, Poor Dad, and Robert Kiyosaki created this game called the Cash Flow Game. It's a board game. And so I found a group in the San Francisco Bay Area and we played it, and it really taught me kind of this mindset of acquiring assets, right? With this disposable income, this income that was coming in from my job. It's so easy for people to just kind of, after rent and food and fun, to not have anything left over. And it really taught me to think about, well, maybe I should be paying my retirement account, my asset account first, and then living off the rest. If you look at earlier videos, I started off making videos about real estate. I spent a year trying to find wholesale deals in the San Francisco Bay Area. That was brutal. There is so much competition for people looking for wholesale deals in the Bay Area. I was sending postcards. I was knocking on doors. I was driving for dollars. I was doing all this stuff. And I was able to close one deal. It was this burned out triplex in Oakland. And I worked out a $10,000, finder's fee for the Homevestors person that I found it for. And, I just realized, this real estate thing, it's not really a fit for my personality. So gradually over time, I came to realize, this stock market game, this value investing game in the stock market, this is really interesting. It's, very analytical, which as an engineer, I'm kind of wired that way. And so, maybe 4 years back, I started investing in stocks and just devouring. Actually, my first step with it, I reached out to like 20 people on LinkedIn who were equity analysts, right? Equity research analysts. And I asked them, what has been the book that has most shaped your kind of equity analyst, career? And I got 5 that kept coming up with these responses. And this Howard Marks book was one of them. And I just dug into those, and it was so refreshing to, who is it? I think Buffett says, you either get it right away in terms of value investing, or you never get it. It just doesn't click. And for me, it clicked. It's like, of course I want to buy $1 for 50 cents. And of course it makes sense that there would be opportunities out there, in an auction driven market like the stock market where that's possible. So I drank that Kool-Aid, and, I've been off to the races ever since. And my YouTube channel is really about documenting this process of learning about how to kind of make it to the, the end of the rainbow. the financial freedom state through investing in the stock market.
Fantastic, Brad. Thank you very much for coming onto the channel. Definitely check out Brad's channel if you haven't already. If you don't happen to be coming over from his channel, if so, welcome to my channel as well. But you can go check out our collaboration from a couple weeks ago now about Equity Commonwealth, like I mentioned before. I'll go ahead and link that in the description below so you can go check that out. But thanks again, Brad, and until next time.
Yeah, thank you, Jack. Appreciate it.
So like I said in the video, definitely go and check out Brad's channel. He has a lot of great stuff on value investing, analyzing companies, talking about what great value investors are doing throughout the world, and he has a lot of great content over there, so definitely go check it out. And that's all I've got for today. If you like this video, please like it, since that would help the channel out a lot. And if you like this sort of content about investing and pretty much everything as it has to do with personal finance, then definitely subscribe, since I put out new videos every single week and wouldn't want you guys to miss out. And definitely check out all the cool stuff in the description below, but until next time, take care.